Hi, everyone. I know there's a lot of other activities going on, but I will guarantee this is one of the most important topic all investors need to pay attention to, which is all about IPO. So for the last few years, been a big IPO dry, but seems like this year, recently, there's a little bit of a turning around, but according to PwC, the global IPO activities have declined 18% in the first half of 2024, with preceding dropping from 58.8 billion, falling from 481 deals to 432 deals. But it seems like things are going to slowly pick up. But having said that, who knows what's going to happen after the presidential election? So all the investors in the room are really waiting and hope that the IPO windows is going to open again. So in the room, we have some amazing, very experienced speakers. So I'm going to just quickly introduce everyone before we go into the first question. So Bonnie Chan, congratulations. You're newly appointed CEO of the Hong Kong Stock Exchange. Just started March this year, so welcome. Thank you for joining us. Michal Katz. Michal is the head of investment and corporate banking for Mizuho Americas. And with over 2 trillion in asset, that's a very large AUM. And congratulations on just being recognized by the American bankers as one of the most powerful women in finance for the last 3 years. Michal, thank you for being with us. And then we have Michael Klein, which is the founder and managing partner of M. Klein and Company, and previously the vice chairman and CEO of Citigroup's Institutional Clients Group. So thank you for joining us, Michael. And last but not least, Alexandra Soto, COO of Lazard and Group Executive Director on the board and senior partner for over 34 years. And also congratulations for being recognized by the Financial News 100 Most Influenced Women in the European Finance. So today we have some really representative from Asia to Europe and of course our US representative. So I'm going to actually start with, so for the investor in the room, we've been waiting for the IPO windows to open. Frankly, for us at Raise Capital, we invested in Databricks, and I think it's been over 10 years, and we're still waiting. So what are some of the key indicators that we as investors should pay attention to when this window is going to open again? And Bonnie, maybe start with you, Hong Kong Stock Exchange.
Sure. Thank you, Edith. The question is, what are the indicators to suggest that the IPO market is open again? In my opinion, at least from where I am, it has reopened. Now, maybe we say that activity level is not back to sort of 2021 when IPO was on fire. But earlier, actually last month, we completed an IPO for a white goods manufacturer called Midea. That deal was $4.6 billion in size, which makes it Asia's largest IPO this year and the world's second largest. Now, obviously, compared to sort of the glorious days of IPOs back in the region, where easily you can raise $25 billion in an IPO, this is just a fraction of it. But I would say that, broadly speaking, I'm seeing two camps, right? Some people decided, like you suggested, maybe we should wait until the US election is over before we hit the market. But equally, there is another camp of business owners which said, there's just too much uncertainty. God knows how long the process is going to drag out. So maybe I should get ahead of the curve and complete my IPO before that. So I'm very happy to report that, where we are at the HKEX, after this $4.6 billion deal, we have, in quick succession, completed a few pretty sizable deals, not quite at the $1 billion mark, but the pipeline is looking very healthy.
Amazing. So Bonnie is basically saying Hong Kong is already back with the 4.6 Midea IPO. And Michal?
Yeah, I think similar to Bonnie, when you take a look at the global volume of IPO issuance, it is down, as you just cited. But for the US, about 30 billion of issuance is 1.5 to 2 times full calendar year 2023. So there's definitely been a rebound in IPO activity. But I think like when you double click on it, something that's really interesting is that the technology sector and biotech have historically constituted somewhere between 50–55% of IPOs. This year, they're about 40%, and the three largest US IPOs are not in those sectors. You have Lineage, which is a REIT, you have Viking, which is a cruise consumer, and then you have Standard Aero, which is aerospace and defense. So when you take a look at the composition of that, it also tells you that there is a robust backlog of real high quality. And then you ask the question, well, what does it take? I think if I was to use one word, it would probably be certainty. We began to get some certainty with respect to the Fed pivot. We got our 50 basis rate cut, and that gave the market an indicator where the Fed's mindset is at. I think the US election, regardless of which way we're gonna end up, will give the market and investors some certainty as to what to expect from a regulatory perspective and what have you. And I did have the opportunity to catch kind of the last couple of comments at the end of the last panel, which talked about valuations. So one of the bigger issues that you have there is that during that ZIRP era, the zero interest rate environment, companies raised money from VCs and the like at incredibly high valuations. And they either have to be patient and grow into those valuations, or there's got to be a reset or recapitulation of short. And I think the gentleman on the prior panel called it, do you mark to market your portfolio? But that's another thing that you should be looking for in terms of assessing whether the markets are open.
Michael.
Well, thank you very much. It's an honor to be part of this panel. I'll try my best not to repeat too much that's been said, and I hope you guys can hear us, because we can hardly hear you guys over here. First and foremost, I think when we look at the IPO market and the discussion of the peak in 2021, it really is such an aberration that it makes it impossible to consider the rationality of that market. So just so we have some grounding, there was 650 billion of IPOs in 2021. Even if you back out the entire SPAC product, there was 500 billion. 500 billion is literally 2.5 times the second highest year and 4 times what we had during the 2000 tech bubble. So 2021 was an aberration, which we'll all discuss, no doubt, as part of this panel. We have actually had the beginning of a significant upturn in the IPO market. It's essentially, principally, but not entirely, been in the US. The US today, about 64 billion year to date. That's about the average over the past sort of 24 years. It's only below that number in a handful of years. So we're in the market today with IPOs taking place. Now, part of the reason why the IPO amounts seem paltry is 2021, but part of why they seem paltry is also because of what's been discussed as this very large backlog of companies that are owned by transitional owners, private equity leveraged buyout firms. They have grown to their highest level in history. 57,000 VC-backed, 11,000 private equity-backed. These are enormous. They are decades worth of IPO possibilities that are in place, and there's 600 unicorns. So these are a lot that are in the portfolios, and has been stated, not just venture. The private equity world usually holds 2, 3, 4 years. They have 50% of their portfolio over 6 years holding. So it feels smaller than it is, and it's begun to open. But to the question of what we should look for, first, having been in this market for 40 years, there's one simple thing to remember. IPOs are bought, they're not sold. You need to have a buyer.
Yep.
Success begets success. The best and most important thing to look for is, how did the last IPOs trade? So before 2021, the 2 years prior, IPOs traded up 100% and 75%, which makes the issuance that much easier. We have not had up trading in IPO markets at all until 2024. The second thing you keep in mind is not just valuation, but the gap in valuation between the growing sectors and the non-growing sectors. In 2000, the tech bubble, 20 times versus 50 times was the gap between the regular market and the market in the IPO space. Today, we're seeing that for the first time with the Mag 7 pulling everything upward. And don't be surprised, because you'll hear it talked about. Since ChatGPT alone was announced, there's been $7 trillion of value created in any company that touches ChatGPT. That's the second factor. The third factor, just so you have a sense for it, is watch the size of equity funds. Equity funds today have multiple different definitions. The only ones that matter for this are active. And active funds are essentially kept at about a $6 trillion level for a decade. 50% growth in 2020 and 21 took them to 9 trillion. That had to be spent. We've now, in 23, 24, seen the same 50% increase in active funds. 6 trillion back to 9 trillion in the equity space. Passive funds, ETFs, those aren't IPO buyers. So look for those three, and you'll find where in the markets you'll see the beginning of an IPO trend.
Okay,
Alexandra.
so I hope indeed you can hear us. I'll go to a different place, which is, I don't think the IPO market is closed. I think it's patchy, number one. Number two, I do genuinely believe that we're going into a different world for many different reasons. Because if anything, currently, given the indices valuation, we should have a booming IPO market, no doubt. And I think we're in a weird environment, and that comes from many different things, from supply, demand, and regulation, those three different things. So in terms of supply, there are companies, but there are many companies that are dreading the IPO market or the quoted company for different reasons. First of all, they've done a round of fundraising 6 months or 12 months ago at much higher valuation than the valuation that they could get today. So there is no way the private equity owners that own them today will accept an IPO. Number two, they think it's quite heavy in terms of commitments vis-à-vis regulation and so on. And number three, most important, there are many other routes for them than the IPO. I mean, the IPO used to be the route to exit and to finance the growth. Today, they have so many more, and in many cases, cheaper. So that's one, supply. Demand, which is what, Michael, you were saying, I think we should just remind ourselves that the IPO has been one of the worst performer asset class in terms of performance for the last few years. So many investors, or many of you have had their, I would say, fingers burnt with IPOs. So there is much more caution, especially for the companies which are profit tomorrow and very high growth, but not demonstrated yet. And you can see that today, the IPOs that work are the ones which are definitely strong cash flow, sustainable growth, going back to the infrastructure, old industry, I would say, versus the non-profitable company. Lastly, I would say on the regulation, and me as a European, I can unfortunately speak about it, a lot of the sustainable, I would say, regulation which has been imposed upon the issuer is definitely a hurdle because it's very time consuming. Of course, it professionalizes the issuers, but makes it quite difficult for some of them. So because of all those three, we are in a sluggish IPO environment that will open. I would say one criteria, what to look for, I think is the IPO discount. Today, we're talking about, and that's worldwide, and I'll come back, 30% IPO discount. When we're going to go back to the 15 or 20%, then you'll know that the IPO market. We need a few wins that will actually make the market better. And you have, throughout the world, very different, I would say, profile. US, as a bank, we have huge backlog and pipeline of companies waiting. In Europe, I have to admit, it's a bit slower. And Asia, I think, is still very strong. And within Europe, I would say the Nordics is one which is still strong. So there are different profiles generally, but it's patchy and it will never be the same, I think.
Alexandra, while I have you you mentioned you're in Europe.
Yes.
I would love to get everybody perspective from very different part of the world from a panel, maybe starting in Europe. Recently, there's even Shein going to try to go IPO in London.
Yes.
Is the London Stock Exchange making a comeback in that sense? And also for European companies, there's a lot of unicorns in Europe, and particularly in the UK. Are they going to backlog that you were talking about? What's happening over there?
Yeah, and I think unfortunately, because of Brexit, we're talking about different markets rather than market, i.e. the European market. And I think it is true that the London Stock Exchange is trying very hard, and I don't know whether there are some representatives in the room here, to make the UK market more attractive. They are actually limiting the necessary regulation. You've had a lot of the companies that have actually gone from the UK to the US because of the multiple differential, because of the depths of the market and the liquidity leading to higher. In Europe, it is different. The loss that has happened in the UK hasn't fled to one. Amsterdam has been one of the winners compared to Paris and others, but this is still not as deep as one we would like on a euro base. So yes, I think they are all conscious of the regulation, trying to make a more attractive market, but I think there is a bit of way to go.
On that note, can I make a comment? So the regulations, I am previously a regulator myself, they tend to address the supply side of the equation, right? So we have seen, for example, London Stock Exchange in the UK, they've announced a round of new regulations, basically aiming to make the eligibility threshold easier, right? And also compliance costs to come down. We see similar initiative in Asia. So Singapore, for example, have done a round of that. But unfortunately, when I look at those types of regulation or regulatory improvements, they really focus on the wrong issue. I mean, as Michael said earlier, right? If you look at the last 2 years where we have a lull in the IPO activity, it's oftentimes, the problem is on the demand side, right? So, I mean, regulators can keep lowering the bar and making it easier and compliance costs coming down, but at the end of the day, that alone will not allow deals to get done because you're not driving that demand, which is crucial.
I'll give you a contrarian view to that, because if you take a look at the 2012 Jobs Act, it was very defined. It was an incredibly consequential act, but it did, I think, looked at limited set of companies, which are emerging growth companies, with limited accommodations for a limited amount of time. With the whole concept was really try to balance that investor protection, but at the same time, advance capital formation. And there are a lot of studies done that when the company's job growth happens post-IPO. We all know, I mean, I've been an M&A practitioner my entire career. You put two companies together, you know what you do to achieve cost synergies and rationalization. IPOs actually do advance more than just shareholder value creation, because I know you talked about the performance of the asset class. It very much does help in terms of overall growth. And there really hasn't been an act that was, in my mind, as consequential as the 2012 Act, which, by the way, has broadened some of its applicability to a broader set of companies. And you're really talking about allowing companies to file confidentially, perhaps provide 2 years of audits versus 3 years of audit. Again, I think that the term that was used, that these were incremental changes with outsized impact. And so trying to balance the regulation to really create, because I will tell you, the cost of going public and the cost of being a public company, and I'm not just talking about dollars, it is about resources and what have you, and I work for a regulated bank, so I can tell you what the cost of regulation can be, is something that can be onerous and make a company think twice, not to mention the fact that you're traded on the exchange daily, that you have quarterly, at least in the US, reporting requirements, that, and the list goes on and on and on. And so I don't think it's about lowering the bar. It is about, in my mind, finding that balance that encourages, because to me, I find it, kind of incredulous that over the last 3 decades, the number of publicly traded companies has halved in the US, from called 8,000 to 4,000. So how do we replenish that? Now, I will tell you that other than the venture-backed companies that we've been talking about, or PE, there are the PE names that have an opportunity to debut or re-IPO. But there's like another way that we have seen companies access the market, which I think perhaps is less dependent on regulation, and that is the spins, the splits, and the IPO carve-outs. And we've seen quite a few of those over the last couple of years. You saw Intel spinning out Mobileye on the insurance side. You saw AIG spin out Corebridge. You saw GE splitting into 3 companies, and I can give you other examples. But those are other ways to repopulate I would say the public markets in an IPO fashion, but not in the traditional VC-backed IPOs.
And Michael, do you think that, what do you think about like other method of going sort of traditional IPO? There's SPAC, there's direct listing. Are those trends coming back, or we should not think about that anymore?
Look, I think first and foremost, the trends that are being discussed, and in particular, as Michal has just described, the reduction in companies in the US in particular and in Europe are a factor of something that I would define much more broadly than regulation, which is the ecosystem for the IPO market and the equity investment market. The regulation, by the way, has by and large, whether it's the US, the recent moves in the UK, and moves here in Saudi, have mostly been highly constructive, and in the cases of the US, very necessary in order to have the right, orderly, well-handled market. That here, you're seeing best practices occur on literally a daily basis in the way they've migrated settlement from T+3, T+2, they can be T+1 here, and the incredible rapidity of being able to work with the CMA and others. Yeah. It's not the regulation. The ecosystem has changed dramatically, and I'll give you just a couple of thoughts. The first is we've seen a dramatic shrinkage of the number of qualified underwriters. When we go back just 10 years ago, less than 40% of the IPOs were handled by the 5 big underwriters. Today, it's more than 80%. That means the bar, if you will, for companies that need capital, want capital, seek to grow their business, is much higher to get access through that funnel. Secondly, the amount of money that banks can spend on research to market has shrunk dramatically. And you can't market a new issue without being able to describe and to provide that degree of research. So that part of the ecosystem has shrunk. But the biggest issue to remember, and it comes to Alex's comment on the IPO discount. The IPO discount is a made-up number. And it's made up because selling IPOs is a 2-stage marketing. You have the initial buyer and you have the long-term buyer. And it's a very expensive process. So you pay your underwriting spread, and then you sell it to the initial buyer at the so-called IPO discount. The combination of that is typically 3, 4, 5% spread, 10, 15, 20% initial buyer, and then you go to the long-term buyer. So it's a 15+% cost. Now that initial buyer can be a number of changing capital markets players, but they come directly out of this active universe. That universe decides to buy when they believe markets are going up and their historic success in IPOs have gone up. And then you have a feeding frenzy on every IPO because those buyers want that asset and want to own it, and they don't intend to hold it ongoing. When you have a process that is 30 minutes long to describe a company with a very highly detailed prospectus, moving from in-person to Zoom, you can't imagine that there is going to be great learning in that process by those investors, which means you have this momentum of the initial buyer who wants to own it for that amount. Some will make long-term commitments, but very, very few will make long-term commitments. So the process is expensive, and the ecosystem has shrunk materially in terms of number of investors, banks that can underwrite, which is why it's great to see Mizuho here building away from Japan on a global basis. We need more underwriters for growth in that regard. Lack of research and lack of capital to trade, because trading desks have given up their capital trading and left it to high-frequency traders. Those elements together really is what drove the thinking process between direct listings, the whole Google auction process, and quite frankly, the use of SPACs, because certain companies needed more analysis, which is what a SPAC did if it was done right. Most weren't. But more analysis and more ability to credentialize a business than you'll get in 30 minutes and sell for an extra 10 to 20% spread. It's the ecosystem that has shrunk.
Yep.
Maybe I want to add 2 points, because as we've been talking about the IPO market, one is scale. I think this is changing. Because of course the asset managers are becoming, the active asset managers are becoming larger and larger, I think scale IPO matter. I think the smallest one, whether it is in the US or in Europe, by the way, or here in the Middle East, scale matters and will increasingly matter going forward. So that's one point that I think we need to keep in mind as we go through who are going to be the success stories to come. The second one I would have liked to add is about the volatility. I think when we said the market is closed open, I think we have to learn as investors or as advisors to navigate a very much more volatile market because of geopolitical news that are coming our way without us anticipating. And it is true that many issuers are fearing that. When you're doing a private transaction, you can actually manage the geopolitical news that you haven't anticipated, and some deals do close with private equity or venture funds and so on. On public markets, sometimes it becomes more difficult, even from mundane news or things that you don't think that matters, all of a sudden the market closes. So that market closing, opening happens much more in the public market than the private, and it is something that people have to take into account.
Yep. I am an early stage venture investor, so IPO is not my expertise, but I really, really want to learn. It's especially when you guys talk about, since now 80% of the deal is done by the major bank, it seems like, let's say for Mizuho, $2 trillion under management, or the Goldman of the world, they don't even want to touch smaller IPOs. And I would love to learn from different regions of the world. Let's say I have a company, actually I have a few. One is doing 100 million in revenue, growing, let's say 50 to 70% year over year growth. And another one, let's say doing, in Databricks case, is over $1 billion. So what would be your advice for earlier stage, actually it's not even the investor, the founder, the CEO, how should they even mentally prepared? If I'm getting a year-over-year growth, 100%, great. But should we even bother from a founder point of view? So what are we seeing in Europe, in US, in Asia, in terms of size? And at what point should the founder be thinking about this and prepare for IPO in terms of revenue and all that?
Maybe let me start. It's a very complex question. And I think as a general observation, the size of deals have come down, right? I mean, I still remember it used to be.
But 4.7 billion is pretty big.
I know, but we used to do like 25 billion US dollar IPOs, in a flash, and we can do that quite quickly. I think that probably speaks to the fragmentation that we're seeing, in capital markets in general. But to your point about the smaller companies and how they should think about it, I think Michael mentioned the cost involved. It's obviously something that you need to bear in mind. And both Alex and Michal touch upon the regulation. I think increasingly, especially for Europe, the smaller companies can find it quite suffocating, right? You have the regular financial reporting on top of it. You have all the sustainability requirements, climate disclosure and all that. However, if you step back, right, and you do have aspiration to become a bigger player, right, in your field, having that public market sort of equity currency, I would say, is still something worth thinking about, right? I mean, in my part of the world, obviously we still, I think we are one of the exceptions in terms of seeing number of listed companies continue to go up. I mean, you spoke about the US market where the numbers have halved. I think, similarly in the UK market, listed companies have come down, but not in Asia. Asia is a place where increasingly in many of the markets, including Hong Kong, you're seeing the number of listed companies continue to increase, and that I think is a reflection of the growth that we're still seeing from a lot of the countries there. So to your point, well, I mean, no easy answer, except I would say that the regulators are very focused to make sure that they create bespoke listing framework for different types of companies. So we talk about segmentation within the listing framework, and you need to basically build a little sandbox, right, where the less resourceful companies can nonetheless tap public market.
I think the question is complex and other reasons as well. First of all, there are sectors where you have small IPOs. Take a look at the biotech, where you have companies that are pre-revenues going, because that is the way in which they're able to continue to invest in, whether it be in a drug, medical device, what have you. So I do want to bifurcate between sectors. There are sectors where scale matters, when you're dealing with industrial, manufacturing, et cetera. With respect to the kind of run-of-the-mill enterprise software company, you're 100% right. The size of IPO has increased, but it's not just because of the underwriters, not to shrug off responsibilities of the banks. There are a lot of investors in this audience and in this conference, and investors have their investment strategies, and they may not be able to invest in a company below a certain market cap. In addition, if you are a micro cap company and you have an investor in the audience that is keen on investing, but there's no float, so you cannot accumulate a position. So I would say it's complicated, or it's multi-layered, because on the one hand, you do want to have a company with a product market fit. You want a company that is early enough so that investors have an opportunity to capture the upside. But you got to balance it with the fact that being a publicly traded company today, when you're looking for the active investor that Michael was talking about, they will require a company with a bigger float. Bigger float requires a bigger size IPO. Bigger size IPO, by definition, requires a bigger scale company. So it is all about a balancing act.
I think that's spot on, and I think we can actually see the dimensions. So the market for equities over the past 12 years is up 5 or 6-fold. The market for active capital is up 2-fold, which means you just have less money, and the amount of that, if you will, when someone wants to spend the time to do the work on an asset that they hold, there's an opportunity cost of their time. There's an opportunity cost at the bank to pay for research and trading. Each of those has limited, if you will, the window and the size of what can go public in most markets. Doesn't mean all markets, but in most markets. There's a flip side, though, which is the private markets have gotten so sophisticated, both private equity, venture, growth capital, and now private credit, that companies can stay private much, much longer and have the equivalent cachet, given the type of investors they have, and the size. I mean, OpenAI, it's public, $6.5 billion on a $150 billion valuation, private for a not-for-profit company. If the market has not gotten sophisticated, that definition tells you just how sophisticated the private side has become. If I'm a founder, and remember there's 2 kinds of IPOs, those that are providing growth for a company and those that are providing exits of something that I've held, 2 different kinds. I have to make a decision. Do I want to be public? Is public the best capital for me? By definition, being public has a cost to it, but it isn't just the listing cost, it's some visibility. So what's the benefit? Does it help me to attract more great employees? Because I have a currency to do that. Can I use that currency for acquisitions? Am I more credible in the world if I'm public versus private? Am I better off because I can get a better quantity of capital to delever? So the questions really come down much, much more to what fits and suits the company itself than it is just on the concept of what the size is. But right now, given the shrinkage of the doorways in, there is a limitation on how many, quote, smaller IPOs. If we still had Alex Brown and Robertson Stevens and Montgomery and Hamburg and Quist, because I'm old, then you would have a lot more.
And my alma mater, Lehman Brothers.
So with that, we have 30 seconds.
30
Alexandra,
seconds.
Final
I think
thoughts.
for investors like you in VC, it used to be Series A, Series B, Series C, puff, IPO, and that was done. Actually, today, I think the beauty of the world today is you have a lot of private capital to turn to, and Michael has said it extremely well. Just think of why you're going to issue, and then you will find the best solution. But I think companies are today, in your world, in a much better place because they have much more optionality.
That's great. Thank you, everyone, for sharing your knowledge with us today. And the IPO is not all in, definitely not one size fit all. It will take a long time, and it also really depends on geography, industry, and please talk to all our experts on the panel. So thank you so much today. Thank you.